There's a payment structure that is extremely lucrative for consultants, yet very few use it. So in this video, I'm going to break down what performance pay is and when you should or shouldn't consider actually using it in your consulting business. So the first thing is that if you don't structure this the right way, it can be not only a massive waste of time, but it in fact can be unprofitable and can cause you all kinds of headaches and issues. And that's partly why a lot of consultants don't use it, because there are some complexities, but it's not as hard to do as you think. Now, I will tell you firsthand from experience that I took on in my early days of consulting a few different, what I would call somewhat performance pay engagements. And I received a bunch of paper, essentially shares in the companies that I was working with, that ended up being useless or being there's no value to them because the companies were not public. Therefore, I could not sell those shares. These were private companies. These were earlier stage companies. And so I have shares. And my mind at that time was, wow, like if this goes to $1, $2, $10, this would be massive. And this is the reality of even, angel investing or investing in companies, that the majority of the companies that you invest in as an early stage investor are not going to work out. And if you're lucky, you're going to have, 1 in 20, maybe a little bit better of those companies, become a home run. And that kind of provides the returns that balances all your other losses out. But for a consultant, that's not what I would suggest. Now, again, nothing here is legal or financial advice, but I'm going to break down what performance pay looks like and how you should actually think about it as a consultant, because it can be extremely lucrative. So let's start off. The first consideration, if you want to use performance pay, and let me just back up for a moment here, because I think if I just launch into this without giving you a little bit more context, it may not be as exciting or relevant for you. So performance pay can allow you to, in many cases, increase what you would earn by 5 or 10 times. So let's just say that you were going to earn $50,000 from an engagement. You potentially could turn that into a $500,000 engagement. And here's the kicker: without doing any more work. You see, performance pay requires that you assume or take on some of the risk. And so risk reward, right, essentially will state or show you that as it plays out, that if you're on the reward side, you will receive outsized rewards, right, for what you're putting in. But on the risk side, meaning that there's a chance that you will not get what you want, and therefore potentially you could actually earn less. So this is an investment that you're making, but if you're confident that you can deliver, and as we go through this list here together, you'll be able to better assess if this is something that makes sense for you or not. So first thing is performance pay, in my experience and what I've seen in working with thousands of consultants and running my own consulting businesses for over 2 decades and doing this myself, is that you should only think about performance pay if you have a prior relationship with the client or company. Said another way, a performance pay agreement should not be where you start in a first engagement with somebody that you've never worked with before. Why? Because a lot of things can go wrong. In order for performance pay to really play out, you need to have a very high level of trust with the buyer, right, with the client. Otherwise, what you might find is that you deliver, you do a great job, they get great results, and there isn't transparent reporting. They change some of how they're managing revenue or profits or other things so that you don't actually get what you want. And I think this is probably a good time for me to explain what performance pay actually is, because I don't think I did that clearly, and that will help. So performance pay, the way to think about this, you're working with an organization. You set a baseline of what results they would expect if you did not get involved with them. Let's just make this simple and say that this company is going to generate $1 million over the next 12 months. Now that number likely significantly larger. I'm just making this simple. So they're going to bring in $1 million over the next 12 months. In the performance pay scenario, that's what they're going to do regardless of whether or not you're involved. But let's now imagine that you look at their situation and you know that you can add massive value. You know how to take them from where they are to a whole new level. And you believe that if you get involved and they follow your recommendations, you can actually take them to $3 million in the next 12 months conservatively. So the baseline is $1 million. You're talking about $3 million. So the delta between those two is $2 million. So essentially your performance pay would be based on the additional $2 million that you are bringing in, right, for the organization. And what you would work out with the client is that you are getting paid a percentage of that additional 2 million. So you're not touching the 1 million that they would make regardless of whether you were there or not. You're going to get paid on the 2 million because that is the alpha, right? That is the difference between what they would make without you and what they're now going to make with you. For you, right? As long as you're confident that you can deliver and get them over that $1 million mark by hopefully a significant amount, depending on what your percentage is, let's just say that you agree to 10% of the additional revenue that you bring in. And this could also be for cost savings. This could be for performance improvements. You could find really any metric that you want to help with to make an impact and to achieve a higher level target. So this could go in many different ways, but let's just say that it's 10%. So in this case, if you went from $1 million to $2 million, and you got them to 2 million in the 12 months, right? That would be an extra $100,000 that you would make at 10%. If you get them to actually to 3 million, that's 2 million of additional revenue. And at your 10%, that's $200,000 of additional, consulting income or revenue that you would generate from that client. So it obviously can be very lucrative depending on how you structure it. And the percentage that a consultant would arrange with the client really depends on the size of the engagement. So let's just say that you were helping an aerospace company and the, numbers that you're talking about are hundreds of millions of dollars. And as an example, or maybe even $1 billion or more, you're not going to necessarily take 10% of that, right? So it really depends on the value that you're contributing and what size of engagement are you talking about, and your percentage will be based on that. I can tell you that in some cases, people are coming in and they're taking as small as 2.5% to 5% of the upside, and in other cases, they're taking even 50% of the upside. A lot of factors at play. We won't get into all of them here in the video today. If this is the kind of thing that you're thinking, hey, I'd like some help with, I'd like to explore, even if it's not around performance pay, but just making sure that you're optimizing your pricing strategy so that you're not leaving a lot of money on the table, go to consultingsuccess.com and click on the coaching button to learn more about our Clarity Coaching Program and how we can help you to grow your consulting business, or just click on the link below this video here somewhere or on this page to get in touch. But let's come back to this. That's what performance pay kind of essentially looks at. Now, the steps that you want to go through, I talked about number one, if you don't have a relationship with the person or the company, don't start with this. Do an initial project first. Make sure that you feel good about them. Make sure that there's a good relationship. There's a high level of trust, and you feel like, yeah, this is the kind of person or people and company that I want to work with and do more with. Then you could think about performance pay. Now, before I actually go on, let's talk about one other element here when it comes to performance pay. What is the benefit to you? So the benefit to you as a consultant is that you can earn significantly more when things work out. The benefit to the buyer is typically that they can pay you lower fees initially, and they're only paying you more when you deliver a result. And if this is structured correctly, then the buyer may end up paying you a lot more than they would have if it was just a strict, standard value-based engagement or monthly retainer or one-time project fee. They may pay you a lot more, but because they're getting a lot more than they potentially thought that they could, and certainly without you, they should be happy to pay you that money. Now, I'll let you know from experience that not all buyers are happy, because when they start seeing they're paying out a lot more than they actually thought that they would be, they start to sometimes feel bad about that, and that can cause some issues. And this is why it's so important that you only do this with people that you feel really good about, and that you have also a very tight agreement in place. So this is not the kind of thing that you just want to do a handshake and get to work. I mean, you can if you want, but I wouldn't suggest that. I would suggest make sure that you have a good, tight, strong legal agreement, not because you're necessarily thinking that things won't work out, but just so that both parties are on the same page and you don't have to wonder about, will this work out or not? So the next thing in the kind of the process here is for you to get very clear on what that baseline data is, right? So what does success actually look like? Both you and the client need to be aligned on this, because otherwise it's going to be very hard for you both to figure out what that percentage should be. What does that performance pay actually look like? And you might find that you're doing a whole bunch of work that is impacting certain things that aren't really that important to the business. They're not the highest priority. So getting clear on this, establishing that baseline, having likely multiple discussions about, hey, where do you think you can get to? What's the historical data showing you? Where are you trending? What might influence that up or down? Okay, here's what I think I can do based on my analysis. And how does it sound to you if I can get you from, back to our hypothetical example, from 1 million to 3 million? Would adding an extra $2 million be worthwhile for you? Would you be excited by that? Do you think there's any way that you could do that with, but yourselves? Have you tried that? What have you tried? What have you not tried? That whole conversation is really important. The next thing is that that you don't want to rush this. Performance pay is one of these types of deals that you do not want to try and rush to get somebody to sign on the dotted line and get to work because of the complexity, right? Because of all kind of the variables at play. And if you try and rush through it to get somebody just to sign and you're like, yes, I have, even if you feel like I've quote unquote somehow tricked or fooled this person into paying me a lot more, it's going to come back to bite you. I always find the best deals in business and even in life to some degree are where both sides win, right? It doesn't mean that your client is not going to have some hesitation or maybe a little bit of like, oh, I can't believe I'm paying this person so much. But you want them to think, even if they're thinking like, I can't believe I'm paying this person this so much, that they're like, yeah, but I'm okay with it because of the value that I'm receiving and because they're taking our company and our business to a whole new level. And there's really no way that we could have gotten there ourselves. And I'd say this is true for all consulting, right? This is what you want. You want to find that level of where clients are in some ways even a little bit maybe questioning like, this is a lot of money. They should feel that. They should feel that this is a big investment. Why? Because a big investment also makes them, take it seriously. Makes it that they're more likely to take action. If your fees are so low, then for a buyer, they can just be like, yeah, whatever, I'm busy. And now they're not paying attention to it. They don't really care if it works out or not. It's important for the buyer to make an investment that is meaningful for them. Okay, so let's keep going here. I said, don't rush, right? Keep these deals, have multiple conversations so that you and the buyer are aligned. Now, the next point here, my fourth point, is very, very important. And that is that when we talk about performance pay, I would highly suggest, again, this is not legal or financial advice. I got to get that disclaimer out there, but I'll just share with you what I've personally experienced and what I've seen with so many clients over the years where people make mistakes and then where they get it right. So what you want to avoid is just doing a 100% performance deal, meaning that your compensation, your pay is only based on the performance improvement. Now, why is that important? Similar to what I just mentioned, you want to make sure that your client has skin in the game. If they're paying you nothing up front, they have nothing to lose pretty much. And so they're less likely to implement, they're less likely to take this seriously. They're more likely to find and to allow something else, a shinier object, a new opportunity to come in and derail what you're doing. You're assuming all the risk, and that's not fair, and it's not right, and it's not conducive to a successful outcome. So instead, what I've found works best is to talk to the client and the buyer, for example, or along the lines of, our regular fee for doing this kind of work is $25,000 a month, okay? Hypothetical example. And so we can do this for that price. However, another option is that you pay us $12,000 a month, and anything above, back to my earlier example, any revenue above 1 million, we get 10% of that, right? And then you would kind of hash out the terms and for how long is that valid, right? Meaning, is it just within the first 12 months, 18 months, 24 months, 36 months, 5 years, whatever, you figure all that out. Now, again, why does that make sense for the buyer? It makes sense for the buyer because their risk or their investment is cut in half. So they're only putting half the amount of cash into this, so their risk is lower. Now, they may end up, right, paying a lot more in total when you're delivering, but they should be happy to pay you more if they're getting the results, because based on the conversations you've had, if you can get them from above 1 million to 2 to 3 million, that's a place they couldn't have gotten themselves. So that's in some ways, quote unquote, free money. Of course, it's not free money, but you get what I'm saying, right? That upside is created or influenced by you. And so you get to participate in that. They still get, in this example, 90% of that revenue. You're getting just 10%, even though that could be very significant for you, right? And for them too, paying, but it's a win-win type of transaction. So this is critical because if you don't do this, you could find yourself doing a lot of work and then something comes up and the project is called off, put off, paused, whatever, and you've received absolutely no pay. The way I like to structure this is that whatever fee you end up saying that you will do this work for, it doesn't have to be 50% of, or about 50%. It could be anything. But the key is, and the way I like to think about this, and the way I advise clients to think about this, is imagine for a moment that you do this work, whatever the project is, and you don't get any upside. If you only got paid that base, let's say monthly fee, would that still cover your costs? And ideally, would it still be profitable for you? It likely won't be as profitable as other engagements, but would it still be profitable for you? And if the answer is yes, then that's likely a good position to be in. Why? Because you're also taking some risk, right? When you think about that risk and reward, there's more risk for you because you may not get any upside. But if you structure this the right way, you still get profit and it still works out. Not as much as maybe other projects. But if it does work out and you get to participate in that upside, that performance component, it could generate significantly more money for you and for your company than if you were just going with your standard, let's say $25,000 a month, right? As the example. Of course, you got to work out the math, right? I'm just kind of throwing you some quick numbers here. So you'd want to think through that. You may also decide that because of this, you want to adjust, because of the risk associated. It's your business. You get to decide what fees you want to charge. And so you just want to think through that. Okay, another point that's really important, I'm just looking at my notes here. You want to think about how to structure this from the perspective of, are you doing the upside based on revenue? Are you doing it on profits, right? So as an example, revenue could be much higher. If I'm the company, right, and you're the consultant, if I think about and pay out on revenue only, you as a consultant might come in and say, hey, here's all the recommendations, and my company makes a bunch of investments and revenue grows. But because we've made a bunch of these investments to get that revenue to grow, our profit may have actually dropped significantly. And so that may not be the right outcome for your client, because even though you've increased their revenue, their profits have actually dipped. That's not a win-win situation. Now, for you as a consultant, you need to also pay attention to that, because if you're only basing the performance on something like revenue, then, or I should say, only based on profits, that can be a bit of a challenge, because if you're only getting to participate in profits, you need to have a real clear line into understanding what the business owner, your client, right, how they manage or decide what is profit and what isn't. Because let's just take the example of, you work with a client and it's $1 million, and the goal is anything above $1 million, and you do your work, you give amazing recommendations, like you're just creating massive value. But now they've also decided that during that time period, they've invested in hiring 3 new people. They refitted their whole office with brand new designer chairs. They got new computers for their team. Well, the company's profits may have taken a massive hit because of all those expenses, but that doesn't mean that you didn't deliver the way that you said that you would. The key, this is not only about revenue and profits. It's figuring out what is the metric, what is the target, and how do you structure this so that it's going to be a win for both the client and for the consultant. I'll say one more thing about this, and that is that for those of you who have a team or are thinking about building a team, you can use this same approach with your team, meaning that you figure out what is, a solid base pay, whether they're coming in as a full-time employee. So let's say it's a base salary. And then you think about how you can create certain incentives and levels that if they hit those specific targets, they get paid a lot more, right? They get a bonus or whatever else it might be. That's a really great structure for bringing people into your company, because for you as a business owner, you're limiting how much money you need to put into something right away. You're also creating the opportunity for that new team member to actually earn even more than maybe they were initially wanting or thinking about. But in order to do that, they need to perform, right? They need to deliver. And having that conversation with potential people you're bringing on really helps you to bring in great people to your organization, because they need to feel confident that they can deliver in order to earn those higher levels of compensation. And for you as a business owner, you should be happy to pay higher levels of compensation when you know that they're actually delivering. So there you have it. There's a lot to unpack here. This is, I will say, one of these areas, like many pricing strategies, but one of these areas that it's not a one size fits all. I actually just had a conversation with somebody yesterday about this, and it requires a conversation. It's not this kind of thing that you just want to jump onto ChatGPT or do some AI searches and look at general applicability, because without understanding the full context and the nuances and your specific situation, you might make the wrong decisions. So if any of this resonates with you, and if you're thinking about applying this to growing your business, whether it's around pricing strategy or your talent strategy of bringing people onto your team, and you'd like some help, then click on the link below this video or head over to consultingsuccess.com, click on the coaching button, and fill in a bit of information about yourself and your situation, and we'll be happy to get on a call with you and explore how we might be able to help you and guide you along this path.